Navigating today's real estate market can be tricky. Want to buy or sell a house, finance or insure a house, or stuck with a house and don't know what to do? Florida Talk Real Estate has been your local one-stop real estate shop since 2012. Get the advice you need from your local real estate pros. Here are your hosts, Jim DePola and Johnny C. live on Real Radio.
Yeah, that's right. It's Saturday morning. It's time for Florida Talk Real Estate. 2 hours of infotainment is what we promise you every Saturday. Thank you for joining us out the gates, whether you're on Real Radio, the old terrestrial radio, 92.1 or 101.7. Thank you very much. Maybe you decided to tune in with a live stream today. Facebook, Florida Talk Real Estate on Facebook. We go live stream. On YouTube as well, Florida Talk Real Estate LLC, live streaming away on a Saturday. Also, home of a ton of informational chunk videos for you to consume. And of course, we are worldwide. If you're listening on your free download, your iHeartRadio app, thank you once again for making us a part of your Saturday morning. Us, well, that's me, Johnny C, your air traffic control. And of course, your starting lineup on a Saturday. Let me say good morning to our producer extraordinaire, Jimothy. I feel like it has been an eternity since I've actually been able to say hello to my man. Brother, how are you?
Doing mighty fine, Mr. C. Good to hear from you. Good to see Mike and Jim as well. And welcome to another Saturday of Florida Talk Real Estate. How you doing? Good, bud.
Yeah, good to hear your voice, my friend. Glad that things are going well with you and the rest of the crew. Now let's get to the starting lineup here on a Saturday morning. Your Florida Talk Real Estate team. Again, I'm your boy, Johnny C. Let's say good morning to Mike Rauch, the mortgage guy from the mortgage firm. Good morning, Michael. How are you, my friend?
I am doing great this morning. Another lovely South Florida winter. Can we say that yet? It's the winter time in South Florida, and of course, we're the envy of most of the country, I would say. And
you know how I know it's winter, Mike? My air conditioning is not running nonstop.
Yeah, that's the other thing. You can expect your electric bills maybe to come down slightly, so that's a little reprieve.
Windows are open occasionally. Yeah.
Huh?
Windows open occasionally.
Yeah, I think I'm finding as long as you have maintained your screens properly, you can do that. But if you haven't, you might get some bugs or something.
It's a good point. Very good point.
Well, anyway, it's good to see you, man. It's been a couple weeks since we've been live, so it's good to feel good to be back, and I think we got a lot of things to talk about.
Oh, we do. We absolutely do. And just enough time to carve it out. Nice to see you. I'm sure we'll do a little catch up here. Also, very nice to see our fearless leader, y'all. Jimmy D, I've told you for over a decade now that he runs a top producing Keller Williams team. And it's the truth. Keller Williams Innovations, you'll find the Florida Home Pros team, top producing team headed by our guy, Jimmy D. It's Jim DePola. Jimmy D, how you be?
Hey, doing good. So glad to see everybody again. Last, 2 weeks ago, we had the preemption for the football game. And then last week, we were all ready to go. And the routers went down in the building, so we had no way to get our signal over to the radio stations. So sorry about that, everybody.
Technology, huh? Yes.
So we've so much has happened in 2 weeks in the real estate market. We're going to talk a little bit about that. Big changes over the last couple of weeks. We also are what I call still in that choppy water phase where things are going, whether you're talking about interest rates or days on market for houses or prices for houses, we're seeing them go up a little bit, down a little bit, up a little bit. It's like choppy water. Nothing really that what we could call to be a trend at this point, other than kind of bouncing around. Mike, when we left, the last time we left, the interest rates were, hold on here. I have this out. Hold on. I know it's here somewhere.
It was too damn high.
Yes, it was. It was too damn high.
Yeah.
Let's see. So 3 weeks ago, we were at 6.61, but the week before that, we were at 7.8. So in November 10th was the high for the year so far, which was 7.08%. This is the Freddie Mac rate. And then since then, we've gone down more than a half point. We've gone down 0.61 down to this week, which is 6.49. So we went down more than a half a point over the last 3 weeks. So for the last 3 weeks, we've seen a downward trend. I don't expect that to continue to go downward. I think that we're going to see it go back up again. But that's kind of just showing the choppy waters that we're in. And a half point is a big difference, right, Mike?
Absolutely.
When you're tight on your budget, a half point.
I think the thing that buyers have really been struggling with all years is how rates have been pricing them out of certain price points, and if the housing prices haven't come down sufficiently, they've been kind of stuck in the shopping mode, forever shopping mode, just because they can't find something that they qualify for. So yeah, any reprieve on that is good news for active shoppers. If you're just kind of thinking about getting in the market, I would say, heck, now's as good a time as it's been since the past. Well, I guess for a while. I was going to say 3 months or something on rates, but if housing prices have come down a little bit and rates have come down, then that's kind of what you're looking for. Those people that have been on the sidelines, Jim, should have been thinking about, and we've talked about, Johnny, the triggers. Like, what are the check boxes you're looking for? Okay, so when rates get to this point, or when housing prices get to this point, now I need to see what's out there in this neighborhood or whatever it is. So hopefully those people have prepared for a moment like this, because it might be time to really hit the streets.
Well, yeah. So we're going to talk about strategies about that and mindset, because I think that's really, really important in today's market, not to make a mistake, because you can easily make mistakes that will cause you financial pain in a way, more so, if you don't handle things correctly. So we're going to try to give you the best tips on how to do that. But also we're going to talk a little bit about today about creative financing and looking at mortgages differently than we have over the last 5-6 years. Because of these interest rates going up so high, we have to take different tools out of our toolbox that we haven't used in a long time. So we're going to talk about that a little bit later today. So if you guys are anybody thinking about buying something, this will be really good tips that Mike and I'm sure Johnny's going to have a lot of questions about that when we get there. A couple other things we're going to be talking about is what the Fed is going to do, talking about choppy waters. Part of the reason why the waters have been so choppy, with things going up a little bit, down a little bit, up a little bit, is because everybody's trying to predict what the Fed is going to do. And there's been a lot of pressure over the last couple of cycles. The Fed meets every 5 to 6 weeks or so. But over the last couple of cycles of those meetings, probably the last 2 or 3 of them, there's been a lot of people saying that the Fed, by raising the bank rate-to-rate bank rates, they're gonna overshoot it and cause a very deep recession. And the Fed is saying we've got to clamp down on this inflation, because if we don't do it, it can get totally out of control, like it was back in the late 70s, early 80s. We went through that. Johnny gave us some really good insight about real estate market back then, which I want to talk to you about, remind people about that. But so the Fed is going to meet next week. So they're going to decide again. I think it's next week. I'm pretty sure it's next week. If not, it's early the week after, but I think it's Wednesday. And they're going to meet again, and they're going to decide what to do. Now, people were betting that we're going to see like a 0.5 point increase. We've had 4 3/4 point increases. And right now we're at 3.75 to 4% for the Fed bank-to-bank reserve rate. We were down to 0.
Forever.
Okay. Right. So we were down to 0. So 3.75 to 4 is quite a big difference to 0, but it isn't even close to where we were before the boom and bust. During the original boom and bust of 03 through 06, the Fed reserves rates were between 6 and 8%, somewhere in between there. So we're still way off where we were during that last boom. So everybody was hoping he was going to slow down to 0.5%, but the jobs report came out and the inflation report came out, the CPI report, and they're kind of at cross purposes right now. So what are we seeing in the CPI? We actually have seen the consumer price index or whatever slow down just a hair. I think we're at 7.7 or something, and we were as high as 8.1. And now we're at 7.7, and we've slowed down for 2 of these reports. So we're not seeing the increases going as fast. And actually now we're seeing that by the end of the year, we might be at a 7.7% interest inflation, if you will, compared to the 8.1 that we were looking at a few months ago. So we've seen it slow down, but we're way off from the 2%, which is always, ever since we've been on the show for 10 years, has been the the goal for the Fed to keep inflation to 10%, 2% or less. So first of all, so what we're seeing is a little slowdown. Everybody's like, now we're not going to see a 0.75%. More reason not to have a 0.75% rate. But now the job report came out, and the job report is kind of wishy-washy. Why do I say that? When you look at the non-farms job report, it came out very, very strong. About 250,000, 263,000 jobs created in non-farm related jobs, right?
Jim, and you mentioned in the start that cross purposes. You're saying like a stronger job report versus a slowing of inflation. Those would kind of be
well,
opposite
yeah.
indicators.
What the theory is that they got to crimp on employment. They got to see a higher unemployment rate, higher than 3.7, which we're at now, and for wages to slow down in order to reduce inflation.
Yeah, that's
because the idea is
the Fed is pointing the finger at income right now, saying you guys make too much money.
Yeah, like you're spending too much. Slow down on your spending, right?
Right.
Not all these government bailouts to the corporate people, right? All the corporate taxes and everything that happens, right? That don't touch that. It has to be the average Joe Schmo going out and going to Starbucks too much, right? So, but anyway,
or finally getting that raise they've been waiting on for
exactly.
5 years,
So,
right?
So the jobs report came out very strong, 263,000, and they adjusted last month's all the way up to 284. They increased it by 10% almost of what they reported last month. And that happens every month. They readjust the month before. So we saw 10% higher than last month for the readjustment for last month. They added an extra 10% of jobs. And the thing is that was a strong month anyway. And then this month we're at 263, and that's still very strong. And if you go back to September, October, November, very strong job market. We had a little bit of decrease from August to September, but after that we've been flat. But even though it's flat and it's less of the amount of jobs, it's still very strong, and our unemployment rate's 3.7. Now here's the thing. Wages went up 0.6%, right? I said that right. Yeah, 0.6%. So it went up 6%, which actually is considered strong wage growth for 1 month. And while that's still not close enough in order to offset the inflation that people are experiencing, they would like to see that wage growth to be negative. That's what the Fed wants. So, the Fed's there, they don't have a laser to go in there and cut things out the way, to affect the economy the least. Because if they were to do that, they would have to pick segments to give benefits to and take away benefits to other industries, and they don't want to be involved in that. So what they do is they take out their sledgehammer, right? When you need a laser. And they take out their sledgehammer, and what they do is they just break things into 1,000 pieces with the sledgehammer, and then we have to pick up the pieces and rebuild it. So what's happening right now is what's been really affecting the economy that's been affected the worst, or the market that's been affected the worst out of all this stuff right now, has been real estate. Real estate is the number one worst performing of those things. Tech is up there too. Tech, there's been a lot of layoffs in tech, but real estate is really the market that's being affected the most. What they're trying to do is raise it enough where the employers back off of giving people jobs, and the jobs they get aren't as valuable as they are right now, and they want to see wage growth go to negative. So they want to break that part of the economy too. They want to break the backs of the worker that's getting paid. And here's another thing to consider. Private employment, even though that we have strong non-farm growth, when you go to private employers, which I think is companies that have less than 500 people, that's down significantly. Hiring in that segment, small business owners, in other words, that's gone down like 10 to 15%. So they're not hiring as much as they were. So what I'm saying is lots of choppy water. Got some high points to look at, some low points to look at. So what do you decide to do? So it's going to be interesting if the Fed does a 3/4 again, or if they're going to do a half. If they do the half, I don't think that there's enough information out there to justify the half if you've been doing 3/4 all this time, because nothing's really slowed down. Do you agree with that, Johnny, or disagree with that?
Oh no, I think they have to slow it a little bit, but definitely increasing. The numbers from Black Friday and Cyber Monday alone is an indication that if they need to slow American spending down, and we're not spending money we have, we're spending money we don't have.
Credit card money now.
But if they're going to do that, like if they're going to slow that at all, they have to continue. The only indication we have is like our last two big spending opportunities, and as a nation, it was over $20 billion. Billion.
Oh yeah, I didn't see. I missed those reports, and I really wanted to see them. So thank you for that. So we had very strong Black Friday, Black Monday.
Unbelievable. Like people were like, "Whoa, we're just gonna do it." It was crazy. Now a lot of it. Here's the really scary part. A lot of it was done. There was a huge uptick, over 70% uptick in the buy now, pay later aspect, which is amazing. If you can get 0% interest opportunity, it's great. But if you miss one payment, you get hammered on the back end of that. So as long as you can stay afloat with that, that's great. It really is. It's a wonderful opportunity. But it is, I think it's a snapshot of where we're at, where it's this perfect middle of American excellence and just absolutely scrambling to get by. It's this perfect middle of it where we want to maintain that, like, this is what I deserve versus, oh, I can't afford that. So we'll just find the way. But
maybe it's American excellence.
Perfectly said.
Excellence. I like that.
Perfectly said. Yeah, we all feel like we deserve it. So, I mean, I get the mentality. I do. You put in a 40, 60, 80-hour work week, you can start feeling a little entitled. Like, man, I deserve that. I get it. But it's they have to keep raising rates. 3/4 feels like the right number.
It's a quick education moment. Just talk, because Johnny, there's a lot of people out there who maybe it's their first time ever doing that 0%, for 6 months or 12 months or 18 months, like at your furniture stores and your jewelry stores and retail and stuff. So Johnny mentioned, just in a quick aside, if you miss a payment, they're going to take the 20-something% interest rate that's on that credit line, and they're going to hit you for the balance for all the months even the ones that you made your payments, right? They're going to kind of like backdate the interest. The other thing is, if you don't pay off the balance that you borrowed within the promotional period, they're going to go backdate your interest as well, right? So there might be some fine, the small print in there that maybe it's like on the balance that's remaining or something like that. But the wise thing to do, it's okay to borrow at 0%. I don't mind that at all. As long as you have a plan to pay off the full balance you borrowed within the promotional period. So if it's 6 months, take whatever you borrowed, divide it by 6, make that payment every month. If it's 18 months, take whatever you borrowed, divide it by 18, make that payment every month. Just a little, what do they call that? The PSA, the public service announcement.
It's a good one too, because you're like, whoa, because you went from not paying any interest to how much interest am I paying? Yeah. You might not have made that purchase.
And backdated interest.
Right.
Yeah, exactly. That's the kicker. It's backdated interest. It's crazy.
Yeah. So for me, Jim, that's an indicator, because the Fed they're really passing the buck. So they went so long with the quantitative easing, leaving the rate at 0, right?
Yep.
For so long, in the name of I don't know what, probably path of least resistance. I'm guessing.
Just to remind you, the rationale behind that back then, I'm not saying I agree with this, is that we didn't have inflation looking at all. We had like no inflation.
Well, that's the time to raise the rates, right? That's the time to start, especially if the economy's strong, jobs are
but strong. I'm just saying that's what they were saying, is that we'll do it when we start seeing inflation rear its ugly head. That's when we're going to start doing it. And we didn't have any. So they kept letting it ride and ride and ride. But the problem is with inflation, it can rear its ugly head pretty fast. And once it gets there, it's very hard to smush it back down again.
Well, as you like to mention in the real estate world, having a tool in the toolbox that's, valuable. That was a valuable tool for the Fed to deal with inflation, right? Or at least it theoretically could be. So I kind of get saving that, or maybe raising the rates at a snail's pace, but they did nothing until we got into a fighting inflationary aspect. And now they're to the point where they're like, well, it's more about your income. We're in the position we're in because the Fed printed money like it was going out of style. And they also want to blame like the stimulus money that went out to the country. Those couple of $1,200 checks isn't what's making people spend $20 billion on Black Friday and Cyber Monday. It's just not, right? So like the Fed's in really pass the buck mode. But I think if they're gonna get a hold of it, they got to keep the super aggressiveness. And I think the American public is showing them like, you got to be super aggressive because you're not scaring us yet. So I think it's coming. I think another 3/4.
Yeah, if we're predicting what they're doing, I think that all indications are it could continue to increases, whether it's a half a point or 3/4 point, like this meeting this December. Jim, the inflation number is not where they want it to be. And so like you said, they have the sledgehammer. The only tool they really have is this little dial that they can slide up and down, right? It reminds me, like, maybe Jimothy appreciate this, like on your board or whatever, you probably have like a master dial that like moves all the other levels like at the same time once you send them, kind of like that. That's what I'm envisioning in my head. And so they just move their little master dial and it kind of shifts everything that's lined up down the line. But yeah, I think we're going to have continued increases. I don't know at what level, and I don't think they're coming down, right? There's any indication that the Fed lending rate is going to be coming down over the next year?
They don't there is little scuttlebutt talk that sometime in 2023, they're going to start reducing the rates again. That's the plan.
That'd be great.
To reduce it. But I don't even know, maybe that's a good thing. Maybe it's not a good thing, because if we were at 6 to 8% during the boom the last time, right, and we were doing okay at that point, we were doing fine. Do we really need to be closer to zero than 5%? Do you understand what I'm saying? So,
I mean, as a borrower of money, I say yes. Like if I'm a borrower, I say, yeah, Jim, let's get it down to zero again. I want my car loan rates to be low. I want my mortgage rates to be low.
But if we weren't at the 6 to 8% when we had that big crash, we wouldn't have had any place to move to help the economy along. I mean, we went from that 6 to 8% down to zero. And it gave us room to like do stuff. That's why having the Fed Reserve rate in there, it's almost like a cushion for major economic blows that happen to the economy, like COVID, like if we had another one of those, or God forbid, some kind of world crisis, that we would have room to go. So I don't think keeping the Fed Reserve rate too low, even though it's great for, the real estate market, I don't know if it's good for the overall like big economy.
I think it takes a pretty pragmatic mentality to look at the overview, when you're the individual, right? So it's like, yeah, I think we should have interest rates around, mortgage rates are at 6 to 8%. That seems pretty comfortable for everybody. Like when you're the consumer trying to qualify for the mortgage, you're like, geez, this really isn't what I want. But eventually it does become normal, right? Like it becomes the market that we're in. And I think a lot of people actually have got to that point. If they've been in the market, active, kind of shopping, they're like, okay, well, it is what it is. Let's see what's out there.
Oh, I'm on board with 100%. Like we want to buy a bigger home for the multifamily aspect. It's been a year since my mom moved in with us, a year.
Yeah.
And in that time, we're thinking like, oh, we'll be able to find our place. And all that's happened is, the values have gone up and interest rates have gone up. So for me, like I'm 100% on board with, let's get back to the Wild West. But there's, from a personal perspective, from a we perspective, which I can easily find. It's just, I'm not in a hurry. Like I have conversations with my mom all the time. Like, you're cool, right? Because we might be here for a minute. And she's, she understands, she totally gets it. But yeah, for an overall appreciation for the future, it's best case scenario to keep rising these rates for sure.
Yeah.
And I think that's what's going to happen in the near to midterm. I would say that they're just going to, the policy is inflation needs to get under control. This is how they're doing it. Why would we expect them to do something different?
Well, I wanna do one more thing before we wrap up this segment, and then the next segment we're gonna do a bunch of shout outs and stuff, which we haven't done in a while. So we're gonna do some shout outs, and also we're going to use the shout outs in order to explain what's happening market, like real life examples of what people are doing in today's real estate market. And it's going to be probably busting a few myths out there also. What are some of the myths that we have today? Interest rates are too high, so I can't sell my house because my interest rate's so low. And I want to buy another house and the interest rate's so high. There are techniques in order to deal with that. Dealing with the higher interest rates by thinking of creative financing. We don't mean super risky financing when we say creative, okay, because that's one thing that we don't like doing on this show. But we're going to talk a little bit about that. And also mindset, or when you're a seller and a buyer, and what to expect in today's market and how to navigate that. But before we do that, since we're talking about money being spent by government, or government trying to control our money, this was a very interesting article I read in the Post. I don't know if you caught it, Mike or Johnny, in there. But in Palm Beach County, there's a class action lawsuit going on right now against the county's code enforcement department. And I found this to be amazing as far as the numbers. What is the class action lawsuit about? There was a guy who had a code enforcement fine. And hold on. Well, let me give you this one lady. This one lady had a code enforcement fine of $3.4 million against her house. She didn't know the code enforcement fine was there until she went to sell the house. The house was only worth about $300,000, according to the article, but there was a $3.4 million code enforcement lien on the property. She didn't find out about it till she was selling it. Obviously, she couldn't sell it with clear title unless that was cleared. So she went through a process, and they wiped out about 98% of the fine and brought it down to $70,000. But what they found out is, as they went through this, is that many people are paying more than double for the fine for interest fees and interest accrual, and what's the other thing? And collection fees,
penalties,
and collection fees. Yeah, and that kind of thing, right? So what I always call it the BS bank fees. When you're going through a foreclosure or short sale, there's all these fees the bank throws onto the deal that eats up all your equity. And I call it like the BS stuff. Well, this stuff is pretty shocking. Like, for example, this other person, they had a $50,000 fine, but they were supposed to pay $97,000 after interest and collection fees. So the guy was an investor. He owned multiple properties. He had a problem with one of his properties. One of the things a lot of people don't know is if you own multiple properties and there's a code enforcement fine or a building department fine, they can actually attach that as a lien to another property, not the property that's in question.
Really?
Because you're an investor. So that's what happened with this guy, right? He owned a whole bunch of properties. He threw some kind of trailer on a vacant lot, and he shouldn't have done it. And he kept the trailer there for 506 days. 506 days that was there. And he was paying $100 a day fine for it. Wow. Okay? So that came out to $50,000.
I was going to say, how do you rack up a $50,000 code enforcement? So I guess it's just what you said. So he's got a finable offense, and he's not taking care of it, and there's a per diem fine on top of the original fine. Okay.
So the guy went to the county when he was selling another property. That lien on the vacant lot was attached to a different property he was selling. So he went to the county and says, look, I'm going to pay you the $50,000. I owe it to you, but I'm not paying you this other $50,000, right? Well, the county said, well, then we're not taking any of your money. And the fine's still accruing at $100 a day right now with the fines and the interest accrual and everything else. So
it's
they're
funny
in a major...
to me, like the concept of adding interest owed on a fine, which is money that doesn't exist, right? It's not like they borrowed money and they've outlaid money that cost them money, and so that's why the interest rate is there. It's just a straight up penalty on a fine number that's a number that they just that invented, right? Or just came up like, okay, you owe me $100 a day because you got this trailer set plus interest on that $100 a day that doesn't really exist.
So you're kind of like the Rage Against the Machine right now, and I totally understand that. I mean, that understand that from our perspective. But when you look at from the government's perspective, and I've covered a lot of code enforcement stuff when I was a reporter, many things. And I also worked on as an investor dealing with code enforcement boards and cleaning up properties. In fact, I'm doing one right now in Lake Worth, right? And the thing is that without those extra fines and stuff, you have a guy like that who has $100 a day fine. He knows it, and he doesn't do anything about it. So he keeps it there for 500 days. Is that right? I'm just trying to play devil's advocate. What is the county supposed to do at that point? Obviously,
I'm not really railing against
doesn't affect the guy, right?
I'm not
That
railing
isn't
against the
motivating him to
assessment
do
of
something.
fines. I'm talking about the interest on non-existent money. That's the part that makes
Right,
my
but what I'm
brain
saying is,
trip
if
a little bit.
$100 a day isn't working to get the guy to do something, maybe $200 a day
Right.
does
right.
it. I don't know. So the other thing is the county. The other thing I read in the article is the county has the right to foreclose at a certain time if they don't handle the code enforcement fine, right? But they've only done that twice in how many years was it? They've only done that 2 times in recent years, right? So the county isn't even using the laws that they have to make people comply. And let me tell you something, having a trailer in a vacant lot might not be a big deal, but it might be a big deal. What happens if you have neighbors, or it brings vermin or things like that, or or people are illegally renting it or using it that way or something, and it's affecting the neighbors. So it's just a weird thing. I just thought it was very interesting. Government's always trying to get money out of you some way. It's going to be very interesting. There's 1,700 people in this class action lawsuit, or potential 1,700 people that all have fines that are paying way more than the fines. So we're going to see, and the county could lose millions and millions of dollars that they're thinking that they're going to get.
Well, the fact that they were wiping them away is fascinating to me. So this is really common in the misdemeanor world, the criminal world, where people get stuck in these holes because they can't afford the fines to get over the hump, and then it just mounts and mounts and mounts.
Yeah.
It's very common in that world. And as you're talking about it, I'm like, man, this is the same scam they do in the criminal world.
True.
And it is a scam in a way. But you know what never happens? Those fines never get dropped for the criminals. But that lady went from $3 million worth of fines to
70,000. Yeah. Now I've done that as an investor. I went to Delray once. I had a totally destroyed house, bought it as an investor. There was $60,000 or $70,000 of code enforcement fines against the property. I cleaned up the house, pulled the permits, did everything, made the house one of the best houses in the neighborhood, and went back to the code enforcement board before I finished the house, way before I finished, and said, look, I can't rebuild this house and pay you $70,000 in fines. I just can't do it. Please work with me. And if I do X, Y, Z, can you reduce the fines? And I got the fines reduced from 60 to 70 to about 15,000, right? Which was still high. They actually gave me accommodation, the code enforcement board, for making the house so nice when I was done, which was nice. But it cost me, I call that the $15,000 letter accommodation.
I mean, Jim, you've got so much more experience than I think either Johnny or me in that world. But I think it's something along the lines of remedy the problem, and potentially the fines that were assessed go away. Like, they're not really trying to break the bank on people. They just want the property.
They're not, but there's a lot of
there's
a lot of manpower and paperwork that goes through all that stuff. A lot of behind the scenes of keeping up with stuff, and
a lot of ins, a lot of outs, what have you.
Yeah, they got to go in and out of the neighborhoods all the time. There's a lot of work involved in those departments. What did you just say, Mike?
There's a line from The Big Lebowski. A lot of ins, a lot of outs.
I didn't hear you say that. I'm sorry. Everybody calls me.
Can I ask you another question on it, Jim? So,
sure.
As an investor, just in general, for you're a seller, when you bought that property, did you know that it had code enforcement fines? And
yes.
Is code enforcement or city fines one of the things that could actually get through a sale, or is that something title is searching for by default, right?
Title.
Is it mechanics liens that can get through, or what can get through?
Well, what can get through is if it's not recorded yet. So
Okay.
if the fine, sometimes they have paperwork that they're going to fine, but they haven't started fining yet. It's not recorded in the county records, the court system.
Okay.
And then the title company might not pick it up. That's why we always tell our buyers to always go to the building department and code enforcement department before they close, like during the inspection period, just to make sure there's nothing hokey pokey going on. That's really, really important. And I'm sorry, we're
Somebody's
getting
posting
some
to you in the messages.
yeah, we're getting some porn
No, what?
stuff on our
No,
website
it's
right
dating.
now.
It's
Yeah.
dating. Jeez.
So hold on here.
It's probably targeted toward Jim. He's
Yeah, sorry about that. I'm just blocking it. I'm blocking the stuff out. So
Terrible
yeah,
bad.
there you go. Yeah, we got fans. So but anyway, yes, you have to be very careful about checking into that, Mike, because sometimes it could not be caught and then you have a problem afterwards. You don't want to do that. And if you're buying a foreclosure, I don't know how many times I talk to people buying a foreclosure at an auction or something, and they don't know what the hell's going on, and they can get in big, big, big trouble. We had a guy named Pete that was a contractor, bought a deal in Delray and thought it was the greatest deal in the world. And as soon as I heard the numbers, I go, dude, you got screwed. And he was like,
There's
no,
a
I
reason
didn't.
you
I
won
go,
that
yeah,
auction.
talk to the attorney. And the attorney's like, dude, you got screwed. But Paul Krasker got him out of the jam, and he was able, I don't know how he did it because it's impossible to back out of auction stuff. But after the deal was done, he was able to back out of it because Paul found a loophole. So thank God for Paul Krasker.
Yeah, really.
Yeah. But hey, let's just go ahead and take a 4-minute break. When we come back, we're going to do a shorter thing because we will cut off at 10, but we're going to do all the shout outs. We have a lot of stuff to talk about with that. And there's a lot of life lessons about what it's like really like in this market if you're a buyer or seller. A lot of stuff to learn from it. That's why we're going to talk about it.
Of course, if we're ever having a conversation that piques your interest, you want to get involved, you have a question, comment, concern, you want to get involved in the conversation, do not be shy. Do not hesitate. Dial 877-927-6969. Jimothy will line you right up. You make that call. We'll take that call. Love talking to the folks. Again, anything we're talking about, or even if it's something that you're like, well, I don't know if they're going to get there. I got to ask this question. Go ahead, jump in. We'll make time for you at 877-927-6969. Of course, if you are not comfortable on the radio, I totally understand. That's why we created the one-stop real estate shop for folks just like you to go to floridatalkrealestate.com or call 888-973-7828. That's the hotline, 24 hours a day, 7 days a week, answered by a live body. You'll find it at floridatalkrealestate.com. Your one-stop real estate shop. It's connection to the entire team. Pros, they're experts in their field, and you have them all one click away at floridatalkrealestate.com. Thanks for being with us every Saturday. We're back in 4 minutes from now. Yep, that's us, Florida Talk Real Estate, right here. It's Real Radio.
We'll be your friend. Follow us at Real Radio 92.1 on Facebook, Instagram, and Twitter.
From the Gordon & Partners Weather Center, have you or a loved one been injured through no fault of your own? Call 561-333-3333 or go to fortheinjured.com.
I'm meteorologist Lauren Oleski for CBS 12 News. Our skies are partly cloudy and mostly sunny as we move through our Saturday. Temperatures will be near 80 degrees. Humidity is nice and low, and it's a little breezy with an east wind around 15 miles per hour. Overall, a very comfortable day. A little cooler this evening. Overnight lows in the 60s, back near 80 degrees again tomorrow.
This report is sponsored by Lowe's. It's pro time because at Lowe's it's Provember. Over 30 days to save big. Full of more inventory, more Lowe's MVPs bonus points, and more of the deals you deserve. Because it always pays to be a pro at Lowe's. Save all Provember long.
Hey, it's your boy Johnny C here, host of Florida Talk Real Estate. They're tops when it comes to helping people buy and sell houses. But Florida Talk Real Estate is so much more than that. For 5 years, I've watched these guys help thousands of our listeners with any real estate need. They couldn't do it without their sponsors, who are experts in their fields. Check it out. Jim DePola, powered by Keller Williams Realty. Their team specializes in helping people sell their house for top dollar, and buyers get great deals on the purchase of their home. That's what they did for me and my family, and I couldn't be happier that I hired them for my real estate transaction. Mike Rauch from the mortgage firm is one of our favorite guests on the show, and he is the mortgage guy. Whether you're looking for a refi or a mortgage to purchase a new home, Mike Rauch will get you the answers you need. The mortgage firm is licensed to do loans in Florida, Alabama, Tennessee, and Georgia, and they have local offices that cover all of South Florida. So if you're thinking about a refi or a new mortgage, go to the mortgage guy, Mike Rauch, and find out what he can do for you. The Mortgage Firm, Inc., NMLS 189233, Florida license MLD 78, equal housing lender. The law office of Paul A. Krasker has been specializing in real estate law for nearly 25 years and has the professional team you need. Upside down with your house, Paul's team can help you conduct short sales, loan modifications, even if you're behind on payments. They also help you with foreclosure defense and bankruptcy. They can even help you get a student loan modification and repair your credit to get the score you need. Paul's full service team has helped thousands of our listeners, and they can help you too. Trident Title LLC is the largest privately owned title company in Florida. When you need a title company to complete a refi, home purchase, or sale, Trident Title has got you covered. Not only do they offer competitive pricing, Trident Title has attorneys on staff to make sure if you have bumps in the road declaring title that you can get the job done. Beware, not all title companies in Florida have attorneys on staff. Trident Title does and complies with all the new federal regulations released last year. Ross Camaronets, owner of Brightway Insurance, has been helping our listeners get great rates on homeowners insurance plans. Haven't checked your homeowners insurance policy in a while? This is a great way to help reduce your monthly mortgage payment. Ross can also help with renters and auto insurance. Ross is only a phone call away and can usually get the answers you need same day.
Call Ross today at 561-425-6228 or drop by his office at 873 Donald Ross Road in Juno Beach.
So now you know why I'm happy to be part of the Florida Talk Real Estate Show, the longest running real estate show in Florida. And all these sponsors are just a phone call or a click away. Just call 888-973-7828. That's 888-973-7828. Or go to floridatalkrealestate.com. That's floridatalkrealestate.com. And don't forget to use the most accurate search engine to find your new home or ask for a free home valuation because floridatalkrealestate.com has you covered. That's floridatalkrealestate.com.
This is Real Radio 92.1 and 101.7. Real talk for the Palm Beaches and the Treasure Coast. This is Florida Talk Real Estate with Jim DePola and Johnny C. Got a question for the show? Call us live at 1-877-927-6969.
That's right. For a 2-hour chunk every Saturday when we are live, you're welcome to dial in, be a part of the show with your questions, comments, concerns. That's the toll-free number. It's 877-927-6969. I'll do my best to throw that at you periodically throughout the show. Of course, always remember Florida Talk Real Estate is .com, your one-stop real estate shop. Also find Florida Talk Real Estate on Facebook, where we stream live on a Saturday. Thanks for those that have joined us out the gates. Of course, on YouTube as well, Florida Talk Real Estate LLC, streaming live and home of a ton of informational chunk videos for you. Johnny C, well, that's me. Mike Rauch, the mortgage guy from the mortgage firm, is with us. Hello, Mike.
Hey, Johnny. Good morning, everybody. Happy South. Oh, that's Jim's line. Happy good South Florida morning, everybody.
Yeah, exactly. Jim, that's Jim DePola with Keller Williams Innovations. He runs a top producing team there. It's the Florida Home Pros team, y'all. Jimmy D, how you be?
Hey, I'm doing great. Happy South Florida, everybody. Now I have to say it. So happy South Florida. Getting ready for the holidays and hopefully have a nice, relaxing weekend, which I need. I don't have any appointments today, so that's a good thing. Because I got a lot of stuff to do. Yeah. So I got a lot of personal stuff to do. But I wanted to roll right into the shout outs right away because there's so many things that are happening in the market right now. There's, with the interest rates being as high as it's been, we haven't seen interest rates this high for over 10 years. And people are freaking out about that. Our buyers are struggling right now. If they're at their upper limits of what they want to buy, they're really struggling because of these interest rates. Sellers are saying, I'd love to sell my house, but what am I going to buy? And I'm going to pay a higher interest rate. So it isn't even worth it, but they really don't want to stay in the house that they're in for any length of time So there's a lot of things going on right now. I was talking to somebody a couple of days ago, and we were talking about, instead of putting a larger down payment on the house that they wanted, right, to buy, that maybe they would be better off putting a smaller down payment. So instead of absolutely putting 20% or 30% down, that maybe they would be better off to put 5% or 10% down on a conventional loan. And for them, the reason why that might be a benefit, it might not, but it's something for them to consider, is that that it keeps cash in their pocket for emergencies. They're a growing family with many kids, and they've got a lot of moving parts, and a lot of things pop up in emergencies. And the family, like most families, are tight on their money. So throwing it all into the house sometimes might not be the best bet. That might be better bet to, like I've been saying a couple of shows, keep your powder dry. Hoard your money a little bit and have it in case you need it for an emergency, right? And the first thing that the person said to me when we talked about less than a 20% down, she's like, then you have PMI. And I'm like, well, yes, you do have PMI, and that's very important to consider. However, let's say that the PMI, I'm just making it up, making up numbers here because I don't want to talk about somebody's personal finances. But let's say the example I used was, let's say that the PMI, which is private mortgage insurance, which is an increase to the interest rate, the prevailing interest rate that you're going to get. It's an increase to that based on the fact that you're not putting at least 20% down on the loan. Okay. So it's actually like a penalty for putting a lower down payment. So
it's insurance.
Yeah. Well,
but it's insurance for your lender, not for you.
Right.
So you pay for it.
You're paying insurance for the lender in case you go under, that the bank is going to be paid the mortgage payments anyway.
A percentage of the outstanding balance. Yeah.
So what I said is, let's say that the PMI is going to cost you $300 a month, but instead of putting $80,000 down on the house, you only have to put $20,000 on the house. So now you're saving $60,000, right? Instead of putting $80,000 down, you're putting $20,000 down, right? Yeah. So that's $60,000. So let's just say that you were saving $300 a month. I just made it up, Mike. So if you took $60,000 and you divide it by 300 a month, it would take 200 months, right? It would take 200 months, which is 3/4 of the life of the loan anyway.
To exhaust the $60,000.
To exhaust the $60,000.
If you took that $60,000, set it aside, and drew on it $300 at a time per month, you would have 200 installments of that $300.
Yes. So if you had emergencies, you could always dip into that fund or something. But if you put it as the full down payment on the 20% down and you're tight, sometimes that isn't always the best situation. Now, I'm not trying to tell people to extend their budgets or go over budget or anything. This is just an option, though, to consider. And the point I'm trying to make, when I even brought it up as a potential thing to explore, they became so focused on the PMI. It's like, well, then you got to pay PMI. It's like, yeah, but what happens if the PMI is $300 a month, but you don't have to put $60,000 extra down on the house? Would that be of benefit to you? And they're like, oh, well, maybe. So what I'm saying is, you have to really talk to all the different players, the mortgage guy, right? The realtor guy. Try to figure out all the different ways to work this market to get the best deal that's best for you. So let's go into a couple of the houses that we've bought and sold over the last couple of weeks, just to show you what's happening in real life market. Okay, so myth number one, can't sell my house for top dollar in this market, right? Everybody's saying, well, the interest rates are so high, how am I going to sell my house for top dollar? Well, let's talk about Tom. Tom closed with us about 10 days ago. Tom closed. Tom was an awesome longtime listener to the show. And we're still working on a video I'm working on right now where Tom's cat made him $200,000 on the sale of his property. But I haven't finished that story yet, so I'm not going to talk about it on this show. But I can't wait to do that one because it's one of my favorite videos I want to do.
So I know the story in the saga of Tom and his cat, but I did not know that his cat got him an extra $200,000. So I can't wait for said video.
Oh, yeah, that's right, Johnny, because you know about Tom and everything because you had conversations with him. Well, Tom's cat made him $200,000. I tell him, and the other thing is the name of the cat
so
is
real.
The name of the cat. This is a real story. The name of the cat is Jacko, so I call it the Wacko Jacko story.
Nice.
The Wacko Jacko story. How the cat made Tom $200,000. So you're gonna have to check out our YouTube channel for that later on. But anyway, so Tom came to us, and
he sold his home for top dollar.
Yeah, we wanted to sell it for top dollar. Now, his house was a little dated. The kitchen was original. The house was built in 1999. It was a 1999 kitchen, 1999 bathrooms. The carpeting upstairs, seen better days. And it needed a paint job on the inside. However, the house had a roof that was 2 years old. It had a brand new AC system. The pool was completely resurfaced and the deck was redone, and they put in a brand new filtration system for the pool. So a lot of upgrades.
A lot of big ticket items.
Yeah, so all the heavy lifting was done, unless you count the bathrooms and the kitchen, because that's kind of heavy. I call that medium lifting. But most of the big stuff was done. So his neighborhood, a lot of the houses are selling in the high fours. But we put his house on the market for $535. Okay, I'm giving you real numbers because we closed this public record now, right? So we put it on the market for
$535.
$535 is what we put it on the market for. We had a bidding war. So what happened was that would have at 535, that would have been the second highest sale in the neighborhood in the last 2 or 3 years. I went back 2 or 3 years, couldn't find anything, and a lot of them were in the high 480s, like for high fours, 485, 480, 490. Mike,
you got to put that context, and I see it flashing on the second highest sale in the last 2 years. Think about what's happened in the last 2 years as far as housing prices and where we're at now. So that's actually, if you let that sink in, that's pretty amazing.
Yeah, right. It's like, so we were really pushing it. So what happened was we put the house on the market. Tom would have been okay with a price much lower than what we put the house on the market for, but we decided to push the limits for a couple of things. We found out after doing analysis, even though that he would be the second highest sale in his neighborhood in the last 2 years, in his neighborhood, a nice gated community in Palm City, he would still be the 4th lowest pool home available on the market in the whole county, all of Martin County, and also the 12th least expensive 3-bedroom home, whether there was a pool or no pool, right? So he was on the very low end, even though that he was the higher end for his neighborhood, right? So
Jim is a real estate nerd. It's the 12th least expensive.
Yeah, I am. I'm a total numbers guy, right? So totally true, right? So anyway, we put the house on the market. So it took us 40 days to sell the house. Now, if we had put that house on the market 8 months ago, it would have been 30 showings over the weekend. I would have put the house on the market on a Thursday. We would have had 30 to 40 showings, probably 5 to 10 offers on Monday. Okay. That is not what we experienced. We put this house on the market. Hold on. Let me tell you when I put it on the market. We put this house on the market. What date was it? On 8/26. Okay. August 26th. And we didn't get it under contract until, it took us 40 days exactly to sell the house, right? So now we only had 1 to 3 showings a week, not a day, 1 to 3 showings a week. People came and looked at it, didn't give us any feedback. They didn't give us negative feedback, positive feedback, nothing. And by day 20, Tom was like, "Hey, Jim, do you think that we should reduce the price of the house?" Now we could have, right? But what I told Tom was I went back and looked and I go, look, you're the only house for sale in your neighborhood. You're the only one. So if anybody wants to live in your AAA rated gated community with the AAA rated schools, middle school, elementary school, high school, AAA, okay? 5 minutes to the turnpike, 7 minutes to 95. So the people that need to commute to Broward or Palm, they're right there, okay? You're the 4th lowest pool home in the county and the 12th lowest 3-bedroom home in the county. Where do you want to go to? What are you going to do lower? Like all you're doing is undercutting yourself. I'd hold tight. Nobody's telling us that your house is bad. We just didn't find the right buyer yet, right? So it took us 40 days. We got our offer. Okay, we're at 535. So I'm going to ask a quiz. What do you think the house sold for? We were listed for 535 for 40 days.
Okay, so I know Jim uses 98%, 97% of sales price kind of as a stat. So I'm going to say 97.5%.
Okay.
What of your list.
Okay, so what do you say, Johnny?
Say you got them 550.
550. Okay.
Oh, geez.
So
going over.
The county average in Martin County right now is 96% of list price to sold price. Now, it wasn't uncommon for several months, especially last year and a little bit the year before, where we were getting 101% and 102% of list price to sold price on average. Can you imagine? But now it's 96 because we flattened out. I got 98.1% of list price to sold price. So I got 525 on 535 list price. Okay. Both of you were, I didn't get the over, Johnny, but here's the.
You mean both of you? Could you announce a winner, please?
Yeah, there's only one winner. Yeah.
Well, because Johnny went over, it's Mike.
What do you got?
What are you complaining? Because Johnny went over, it's Mike. Mike won. What do you complain about? There you go.
You're equivocating there. You're marginalizing my victory.
But here's the point I'm trying to make on that. Tom was thinking about dropping the price, right? And he would have. And if I were a weaker agent, I could have just said, sure, why not? Because if he's okay with it, why wouldn't I be okay with it? But that's the difference between hiring an agent and a consultant. And when I looked at the numbers, it's like I'd roll the dice, and I don't think you're gambling. It isn't a gamble. It's just that we're in a more normalized market where people actually look at houses, go home and think about whether they want to buy the house or not. Whoever thought that would happen, right? So the thing is, having 1 to 3 showings a week is okay. It's okay. As long as you're not crazy priced, which there's a lot of people out there crazy priced. Okay. But if you're competitive and you know what you're doing, you can still get fabulous results for your customers. And remember, even at 525, we were the second highest closed sale in that neighborhood for at least 2 years. Okay. Second highest. Okay. And the bathrooms were dated. The kitchen was dated. The carpeting needed to be replaced. The inside of the house would be nice to get a paint job. It was a nice house. I mean, Tom kept a clean house. It was clean. It was just that a lot of it was 1999. It was in excellent condition, just 1999, right? We still got a really great price for his house. How did we do that? We did that by understanding our numbers, marketing it the right way, right? I don't know how many open houses we did for Tom. You heard us on the show all the time talking about the open houses, right? We had a lot of people, doing open houses for us on that. And also following the market every week. One of the things I do for my customers, and I bet you people listening, you never hear this. Okay, one of the things that we do is if the house isn't sold in 21 days, because that's our goal, okay, is to sell the house in 21 days, even in today's market. After that, what we start doing is we start looking every Monday or Tuesday, and we look at what happened in the last week. How many new houses came on the market? How many of the active, or how many of them had price changes or came back on market? How many of them went pending? And how many closed in the last week? And we look at that every single week to make sure, A, we're not being undercut by the market, that we're still staying competitive, okay, and keeping on top of those numbers. So with Tom, when he was thinking about reducing the price, and I was like, there's no numbers here to show there's a reason that we should reduce our price. Nobody's undercutting us. We're still one of the lowest priced homes in the county for the features that we have, even though that we're one of the highest in this neighborhood. So let's just hold tight. And the results came out. Okay. So now let's switch over to Daryl and Amy.
You should sum up that last one. Just like you got to deal with a real professional. Like Jim, I'm just thinking to myself, like how many agents have an opportunity to reduce a price after sitting for 30 days on the market? And they're like, no. Right. Like, so just a real professional approach. That's what I got out of that. So congrats on that.
Well, thank you.
FloridaTalkRealEstate.com, by the way.
And then, thank you, Johnny. And then Daryl and Amy, here's another great example of how the market's changed, but it doesn't mean that as long as you have a good plan and a good result, you can still get what you want. So Daryl and Amy are not closed yet. We've gone through the inspection and the appraisal was just finished. But Daryl and Amy came to us, longtime customers. We saved their house in 2013 during the crisis. Daryl was a city worker and had his hours reduced tremendously. And this family is like, to me, they're one of my favorite families I've worked with over the years. Adopted a bunch of foster kids, then had a miracle baby. We helped them save their house so they had a nice, safe place to live for their growing family. We got them the loan mod. Then in 2019, they came to us and said that their house is too small for all the growing kids. There was enough equity to barely get them into a new 5-bedroom home. We helped them do that in 2019. And now they're selling that 5-bedroom home because there's enough equity in that house now where they could go and move to South Carolina, which is their dream. They want to move to South Carolina. So, but they really need to get every dime out of this house because they're not making a ton of equity on it, but the equity is really good. And they feel like if we don't do it now, we'll probably lose equity over time because the market's changing. They don't like the interest rates and everything, and they feel it's as good as it gets. So they really feel like if we don't do it now, we might be stuck in the house like they were with their first house, and they didn't want to do that. So we put it on the market. I'm not going to go over real numbers with this because we're not closed, but I'm going to use fake numbers, but they're the same ratios. Okay. So we put the house on the market for 600. Okay. I really felt like it would have been better to put the house on the market at 570, 565, but they wanted to go for the 600. So we put it at 600.
Or even 599.9, Jim.
Yeah, I guess you could do it that way if you want.
Right.
So here's the thing, though. I knew that Daryl and Amy are very kind of impatient people because they're raising 4 young kids and it's just total chaos all the time, right? So I sat down with them. I go, look, if we put it at this higher price, are you going to be okay if it takes us 30 days to sell the house? And he was like, yeah, no problem. And I go, 60 days? If it takes 60 days to sell the house, you're going to be okay? Yeah, no problem. And I go, 100 days? How about 100 days on market? Are you going to be okay with that? And he kind of blinked a little bit. And I go, that's your poker face. But here's the thing. I know Daryl very, very well. So I'm like, you're going to start bugging me at 15 days. I know it. You're going to start telling me at 15 days, how come my house isn't sold? So day 14, Daryl calls up. We were getting 1 to 3 showings a week. We got an offer in the first 14 days, but it was way low. It was like $100,000 below our list price. So
cash offer?
No. And it wasn't very good financing either, Mike. And so we didn't even counter. And I didn't try to pressure him to work with that offer or anything. It was just so far off. The agent was very unprofessional. I don't want to get into it right now, but the financing was very sketchy. I was like, it isn't worth even trying to make this deal try to work. If the buyers are serious, they're going to reconfigure an offer and come back to us, which they didn't. So it took us they wanted us to drop the price after 14 days.
They
And
meaning the owners?
the owners. And I
Okay.
was like, well, your house is the least expensive 5-bedroom home in that general area. So what are you going to drop it to? Well, we're waiting for is a person just like your family. Your family had to have a 5-bedroom house, not a 4-bedroom. They needed a 5-bedroom house. This is a very good school rating system. It's in rural Palm Beach. Very, very highly rated schools. Gated community. You got all the check marks. There was a couple of downsides. The house was a little dated again, just like Tom's. But there was a lot of check marks there. And I said, we should hold tight. Well, I was out of work for a couple of weeks, and I was away for a little bit. And while I was gone, they decided to drop the price from $600 to $590, and then said, we'll offer you, if you give us, quote, the right price, we'll offer you a discount to pay for some of your closing costs, which I would not recommend you do things that way. Okay. So they put it that way. That was probably on day 20.
You're saying they're waiting for you to be out of commission, and then they're making moves. Is this Nancy who's pulling the trigger?
Yeah,
on this stuff?
Nancy did
Oh
it
my
without
God.
me. So
Wow.
So we put it under contract on day 42. It took us 42 days to sell. Tom was 40 days. So let's say that we had the house on the market for $590. Okay. What do you think we got the house under contract for?
Johnny, you go first this time.
Damn it. Do I go back to the well again? 587.
Okay. Mike?
Can I do percentage based again?
Okay. Are we going to do original
No.
list
Okay. All
price
right.
off
So
a
you had it
current
listed
list
at
price?
590, 42 days on the market. You're offering an incentive. So I'm going to say 585.
Okay.
With
we
the credit.
got your Johnny won this one because he was closer by 20 something $100. It was not 590. We got the list price. We got the reduced list price, right? And I think that if they didn't drop the price I was gone, we might have got that. But it doesn't matter. The price they got was very, very competitive in the neighborhood, especially for the condition of the house. We went through the inspection, Mike, because they did offer that concession. They didn't ask for anything during the inspection period, which was great. So the concession,
and the 590 is higher than you wanted to list it for in the first place, right?
Yes, so they actually did a little better. But however, I think if we put it at the 565, 575 at the time, we might have had a little bit of a bidding war, maybe. But they did very, very good. And you know what? So let's just go off the 600,000 original list price. We then got it at 590. So we got off the original list price, not the reduced list price.
98.7 or something.
We got 98.3, right? So both houses, we got 98% of the original list price. One, we had a price reduction. We still got 98% of the original list price. Okay. So county average right now is 96, 97% in Palm Beach County, right? So I'm doing better than the county average, which I say is like putting money in your pocket. It's like saving on your real estate commission because I'm getting you 1% to 2% higher than most agents are going to get. And I told them to hold tight. They were freaking out. They wanted to drop the price even more. Okay. So they did good too. Daryl and Amy are doing very good too. And we're trying to get them up to South Carolina. We have them with the top agent in South Carolina looking for rental properties and new homes for them, trying to figure out how that's going to work. So 2 seller experiences, 2 different counties, 2 houses very similar. We use our systems. We plug the houses into our systems, which is know your numbers, know your competition, advertise it right, don't panic. Understand your numbers on the back end after you list it, so you're not just running around. The biggest problems that a lot of agents have right now, they don't know what it's like to be on the market for longer than 10 days, 14 days, because there's so many new agents out there. So they're on the market 30, 40 days, and the sellers are freaked out. A lot of sellers are freaked out. Why hasn't my house sold? Why hasn't my house sold? In 2019, according to the Sun Sentinel research, in 2019, people's houses were on the market 50 something days. Today, even in the slower market, we're on the market on average 30 days. Okay, so it isn't like we're like in this crazy thing. So you have to be able to coach the sellers on when to make the right decision. Now, sometimes if it's overpriced, I'm going to tell you it's overpriced and you need to do something. But a weak agent isn't going to understand any of that. They're just going to say, hey, the house has been on the market 30 days. I agree with you. We really need to drop the price. That isn't necessarily true in this market. You have to know what your competition is and where you stand compared to that competition. And if you're not doing that and you're just looking at your house and how long it's sitting there, that's not a good way to sell your house. You're not going to maximize. You're not going to sell your house for top dollar in today's market that way. So just remember that. Now, let me go over to buyers. Okay, we're going to switch over to buyers. We had Richard close with Mike Rauch and Ross Camarines for Brightway Insurance. We didn't use Trident Title, I don't think. But the
it's Palm Beach County, so.
Yeah, listing agent. Yeah, so we didn't get to pick it. But the listing agent was the Keller Williams agent, Robert. He did excellent on this. Robert was a great agent to work with. It was a pre-foreclosure that Richard bought. Kind of interesting. You hardly see any pre-foreclosures in today's market. It's like 0.3% of all the houses listed are in pre-foreclosure. So we ended up.
Also wasn't this the one with the PACE lien too?
Yes, it also had an energy lien because they put solar panels on it, and they used that energy PACE loan, which has to be paid off on the sale of the house, and the house was in bankruptcy. So we had to get a judge to agree to allow the house to be sold during bankruptcy. And the house had a 4-year-old roof. It had impact windows everywhere. The kitchen and the bathrooms and the flooring had been upgraded over the last 5 to 7 years, I would say. It had a whole house solar system. I think it was equipped for a whole house generator, but the generator wasn't there, if I'm not mistaken. And had a really nice backyard, and it's going to be a great, great home for Richard for his use of what he's planning on doing it. He has a relative living there, and eventually it might become an investment property, which would be an excellent investment property. And everything went really, really smooth for Richard. And it took us about 3.5 weeks to find the house. He came to me with the house he wanted to buy. And when I did the comps on the neighborhood, the house was way overpriced. And then I found out that there was a kennel in the back of the house. So like behind this property was another property, and the people were using it as a dog kennel. So all you heard was woof, 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 24 hours a day. And I was like, Richard, who knows how long that's going to last? And you're going to have a lot of battles with the code enforcement about that, unless you don't mind dogs driving you crazy. And the house is really overpriced. Let's try to find something better. And we did. We found that house, and he was really, really happy with it. I think he'll have really good enjoyment. Nice. And he paid a little higher interest rate than what he would have paid last year, but it all worked for him, and the numbers work for him. And it was a really good experience, right, Mike?
Yeah, I mean, well, Richard was just a breeze to work with. Like, there's certain borrowers who you ask them for stuff and they turn it around right away. And so he was easy pretty much across the board, and was in a really good position, was not like pushing limits as far as like what he qualified for, and the cash availability was there. And so, yeah, it just was a really smooth transaction. I wish everyone was like that. They aren't, but this one was smooth, right? From start to finish, with the one exception, which was the one of those inspections came back and had some issues we had to deal with from an appraisal perspective. But we got it knocked out, and it was pretty smooth other than that.
Yep, and then they also had to go to the judge to ask the house to be sold while
I wasn't aware of that part
bankruptcy.
of it,
so there was a little sticking point there that we had to jump over, hoop we had to jump through.
But that was a good lesson in the beginning, Jim, because when we were putting numbers together, I saw that PACE lien, and a lot of LOs aren't going to see that. And so I just right away got with Jim and said, hey, Jim, there's about a whatever X tens of thousand loans.
It was a lot.
The seller needs to know that they're paying off at closing. Like, just make sure that they're aware of that. And we did that, right? You got to do that homework You don't want that big surprise at the end where, sellers $40,000 less in proceeds than they anticipated, right? Because they thought this lien would stay with the house, which a lot of people do. They're not aware of that. So
Yeah, when you get those energy loans, remember we had that fan of the show, Mike. I guess he called us about 18 months ago, and he was really upset because he wanted to refi to take advantage of the lower rates. Remember those days?
yeah.
And then he couldn't because he was going to have to pay off that energy loan that he got, and he didn't understand that it wouldn't, like, he couldn't refi and still keep that other loan. He had to add that into it. Then his house was like upside down. It didn't, for a refi, it didn't work anymore.
He wasn't thinking of it as a second loan, right? Which you have to consider when you're talking about loan to value on a refinance, right? Like, what's your equity position? So yeah, there was a little surprise there. One of my favorite stories, Jim, is I was looking at a refi for somebody down in Dade who bought a home with financing through all the normal channels, and a PACE lien stayed. It wasn't paid off in the sale. And I spotted that when I was looking at refi numbers. And it was something like $23,000, right? Where she was basically paying it back through the taxes, and she shouldn't have been. And so I got Krasker on the phone, turned into a title insurance claim. Guess what? Title insurance does work from time to time. Title insurance paid off the lien.
Nice.
That's cool. So that's what
they should not have closed. Yeah, they should not have closed with that lien persisting through the sale. So
that should have been caught.
That was a nice moment. Yeah.
Yeah, that's really cool.
Great.
Now let's talk a little bit about tips with these high interest rates. Okay, Mike, let's go over some of that stuff. Okay. So we got as high as 7%, 7.08% according to Freddie Mac. So if the interest rate is 7%, Mike, and you're not putting 20% down, your interest rate really isn't 7%. It's 7% plus the PMI, right?
Yeah. So just take a standard conventional loan, and you're going to have mortgage insurance is kind of assessed as a percentage, right? So if your interest rate is 7%, your mortgage insurance, let's just call it 0.5, right? So 0.5%. You're effectively paying while you have the mortgage insurance in place 7.5% every month. That's the way to think about that.
Right, and it could get kind of high, like 7% could turn into 8.25%, right?
Yeah, and so much like your normal interest rate, mortgage insurance is assessed on a tiered basis based on your credit and your down payment, right? So if you're putting just 5% down and you have credit on the lower side, your mortgage insurance factor is going to be up here versus, say, putting 10% with excellent credit where you're on MIs. So maybe instead of 0.3, it's going to be 0.81, right? Or something like that. So yeah, it can get pretty expensive. And especially if you're higher risk, meaning low down and low credit, you can really have a pretty expensive mortgage insurance factor.
Right. And then, so what I'm saying, what I'm trying to say is that, or bring out is that the interest rates can really kill a deal in today's market because the prices haven't really reflected the interest rate increases yet.
Yes.
Because what would normally happen with the interest rates going this high, you would see the prices going down. We are starting to see a little bit of that. I didn't go into October's monthly report because of all the screwy things that happened with the radio show over the last couple of weeks. But the bottom line is we're in choppy waters. We got, like, Palm Beach County for single family home. The peak was 620 for the median price value for a single family home in Palm Beach County for the year. It was 620. We got as low after we hit that 620, which was the summer. We got as low as 560 at one point for the median sales price. But I think last month we were at 575 or 570 in October. So we've seen it go up and down a little bit with the variance of like 3% going up or down. So, but we didn't see like a straight drop. We didn't see like 620, then 610, then 595, then 570. We're not seeing that. We're just seeing it go up and down a little bit. So we're in choppy waters still. So
I think, Jim, from a practical standpoint, buyers are seeing more hits on their radar, right? So whatever like criteria they're searching for, they're starting to get more pings on the radar, right? So what's that a symptom of? So higher inventory, like prices coming a little bit more into their zone, less buyers out there, so the houses are staying on the market longer. And so, you can look at the market, and it's not, I guess how else do you define it? It's slowing down a little bit, right? So which should be good news for buyers.
Yeah,
Price reductions are starting to happen. You're starting to see that, right?
we're seeing that, but not as much as you would expect, Johnny. It's very surprising. I'm really surprised that people haven't caved in as fast as I think they should. Right? They really haven't. So there's a lot of houses on the market, 120 days, 150 days. You're starting to see more and more of that because those sellers just won't budge. I want what I want, and if I don't get it, I'm just going to keep it there. And sometimes I just got done saying, don't drop your price too fast. But you've been on the market 120 days, even in this market, and you're not getting offers or you're getting feedback and ignoring it, you're not priced right.
No, they're in the market.
Jim, there's so as a buyer's agent, you should be looking for those houses where the sellers have mentally dropped their price, because that's where you have an opportunity. You don't necessarily want the price drop, Jim. You want them to accept less money, and you want to do that as a seller credit, and you want to use that credit.
So let's
you want to use that credit towards something on your end of the deal. So you got to Go ahead.
So let's go into Venessa then. Okay. So Vanessa's a first-time home buyer. Okay. Now we're not going over real numbers. We're just going to talk we're going to use Venessa. She's a real life example, but we're not going to do it with real numbers for her, but we'll be close, just rough numbers. So she came to us. She really wants to buy a house. She really needs to, single mom, 2 kids. She has a good job, but she's really feeling like she's priced out for a 3-bedroom place. She really would like a 3-bedroom, but she's really in a 2-bedroom budget. And it's very tough for her because she has young children, and actually she has a younger child and then a older teenager. So having them live together is a little difficult. She really needs that 3rd bedroom if she can get it.
And she's been through the frustration of the double whammy of interest rates increasing plus prices going up, because when she started, that was still happening, right? When she started earlier this year, it's like interest rates on the rise, prices were still holding or even going up a little bit. And so she was really struggling finding something that worked.
And then the interest rates started rising. So at first, when we first met with her, because of her rental situation, she was like kind of kicking the can down the road a little bit. It's like, I can go find a place later on in the year. But the interest, even though the prices were going up, she was like, well, my lease is so far out, I'm going to wait. But then when the interest rates started going high too, that's when she was like, I got to go do something now. Even if I have to break my lease, I got to do something now if I can. So one of the things we noticed a couple of weeks ago was, me and Mike are always trying to be very creative. She's going to be using a down payment program that gives her $10,000. It's called the U.S. bond program. I think it's called the U.S. bond program, but it's a $10,000 to help pay for the closing costs on her house. But what Mike and I figured out, really Mike did, was that when the interest rates got up to 7%, we're at 6.5 right now, but when we got up to 7%, Mike noticed that bond program loan was locked in at 6%. So if you did it right, you were saving us a point off of the current prevailing interest rate, which is used because that's like 10% purchase power. But then Mike found out, I think it was last week, that they reconfigured that now, Mike, right?
Yeah, it's sitting at, on that program, if your FHA is sitting at 6.5.
Yeah, which is where we are right now. So meaning that the prevailing rate right now is 6.49. But that was one way we were going to, if we found Venessa the right house, we were counting on the fact that she was only going to pay 6% when everybody was paying more. Okay. Now, the other thing we figured out was there's 2 types of loans out there that we've talked about. I'm not going to go into great detail about it, but there's one called a 3-2-1. And another one is where you buy down points to lock in the rate. And it isn't really programs. I call them programs, but they're, what do you even call those? Services or
I mean, you used the word creative financing before. I think it's an option that's not looked at often, but is something that I don't know if it's like a new thing. I've never heard of it until now, but I wasn't in this cycle like leading up to, the crazy financing time. So it's not a crazy financing scheme. It's just a way to relieve pressure on buyers by giving them a lower monthly payment obligation in the first 3 years of the loan.
Yeah. So the way it works is with 3-2-1. Let's say the interest rate's 7%. Okay. So the first year you pay money for this, you pay money for this option, and you buy down the points, or in a way. But what you're doing is if the first year you're going to pay 3% less than the prevailing rate that you locked in at. So if you lock in at 7%, and you got to qualify for the 7% mortgage. But if you do that, the first year, you only have to pay 4%, which is 7% minus 3.
Right.
Okay, 4%. The second year,
5%.
which is 5%, which is 7% minus 2.
Yes.
And then the third year, you pay 6%, which is 7% minus 1,
Yes.
which gives you the 3-2-1. And then on the beginning of the fourth year, you go
You're
back
paying
to
the
the
7% payment.
Yeah, you're paying the interest rate you locked in 3 years earlier.
Yeah.
And then your hope is during that 3 years that maybe the interest rates went down and you could refi. And if it hasn't, at least you know that your interest rate that you locked in 3 years ago is either as good or better than what you can get on the open market now. And you've been able to save payments over those 3 years. Go ahead, Johnny.
But the key thing here, I think, was the first word you spoke. You have to qualify for the 7%.
You got to qualify for the 7.
This is not the world where you get the teaser rate and you qualify on the teaser rate and you're like, oh, geez, I hope my situation gets better and I can afford this payment, even though I've pushed my limit. So, yeah, you're still qualifying for the higher payment, and you're not even getting, Johnny, effectively, you're getting a reduced payment. But what happens is the payment is still a 7% payment, but you're getting the seller to pay the difference in the interest up front, right? So say the seller is going to kick in $15,000. It's going to sit in this account, and you're going to pay the equivalent of the 4% rate for the first year. And that money is slowly being depleted from the account to make up the gap.
So,
right?
Excuse me. So as a buyer, Jim noted that there's a fee, like buying points, right? So there's a fee for this 3-2-1. If the money's coming from a concession from the seller, why does the buyer have to pay a fee for that?
So there is no fee to the buyer. It's simply you're negotiating
a
credit.
The fee has to be paid by somebody, and we're asking the seller to pay the fee. Sometimes the buyer can pay that fee too, right, if they wanted to. But we're asking the seller. Mike, you look confused. Am I saying that wrong?
You know, I don't know the answer to that, Jim. Actually,
no,
I feel like those funds have to come from parties other than the buyer, but maybe I'm wrong about that.
Oh, I don't think so. I think you could just buy a 3-2-1.
I could be wrong about that.
But the thing is that we're going to ask the seller. So in Vanessa's case, she found a house that met her needs, but when we put it in Mike's great app, we've been talking about Mike's app all the time, right? So we plugged in all the information for Vanessa on Mike's app, and it came out rejected. The amount for the down payment, because in the app, it tells you how much you could afford for your down payment and how much you could afford for your monthly mortgage payment. The down payment was too high, meaning the amount of money she had was less than what was needed to buy the house, but also the mortgage payment was too high for her, that she wouldn't qualify. So the next thing we did is we tried to figure out if we can get the seller to do a 3-2-1. Would that work? Well, that couldn't work because at 7%, she wouldn't qualify, right?
Yeah.
So then what we did is we did another calculation where Mike knows about this option where you could buy down the points. This is what I was surprised about. With the 3-2-1 in Vanessa's situation on that specific house, it might have cost as much as 4.5% that the seller would have to contribute to the buyer's to the buyer's purchase price as a contribution in order to get that 3-2-1 program. It was going to cost about 4.5% of the purchase price. But if they just bought down the loan, Vanessa would only need 2% from the seller, right? And she would have qualified for the loan. Okay. And if we got 3%, she was golden, right? She would have had a very, and the 3%, Mike, was roughly like, if it was 7% for the prevailing rate, she was going to get like 3.2 to 3.5. I mean, 5.2 to 5.5 with the buy down, right?
Yeah, and so this is going to vary from borrower to borrower, but
Right.
let's just say what Jim is talking about is like if you have money from the seller, kind of as a credit, right? Like that's what we're talking about. This is money the seller is going to be contributing to the deal, essentially. You have different areas where you could send that money, right? Do you want to send the money to do the 3-2-1 buy down, which will give you a lot of like substantial relief in your pocketbook because your monthly payments are going to be at the lower rate, kind of subsidized by the seller's funds. And so that can really help in the beginning stages of your loan. Like it's just going to keep your monthly payment lower. Option 2 would be to take that money and do what I would consider a permanent buy down, right, Johnny? So instead of a temporary buy down, it's a permanent buy down. You're just simply paying money to reduce your interest rate, right? So it's effectively prepaying interest, right? It's kind of the same thing, but you have now a 30-year fixed rate interest rate that is lower than it would be otherwise, right. Not quite as low as the first or maybe even the second year on the 3-2-1 buy down, right?
And paid for by a seller concession.
Right, and it's locked in. And it's locked in. So you won't see your payment rise each year, right? It's locked in.
And kind of the thought process there, Jim, is like, so maybe part of the idea is I'll refinance into the lower rate loan when the time is right. The question is, when is that going to happen? Like when are the stars going to align so that you're able to refinance? Because home value and interest rates are both critical. And of course, the ability to qualify are all critical to being able to do a refinance in the first place.
Yep. So, and then we figured out that Venessa would qualify for that house if we got the seller to give us contributions. And then
to lower the rate, to lower the monthly payment,
right.
To put her into a payment that she qualifies for. Yeah.
And what I really liked about that example when we were going over everything, Mike, and we explored all the options, was that for 3%, she was going to go from like with a 3% buy down, meaning if the seller contributed 3% of the purchase price towards the buyer's buy down, they would go from roughly 7% to about 5.25%, and that would be locked in for the life of the loan. And let me tell you, 5.25% is a pretty good interest rate. Any market. Bad. It is not a bad, because we've hit 5% every year, like 2018, 2019. I don't know about 2020, 2021. We all got into the 5%, and then it went back down again. So just to be in the fives is a very good number to be at, to be locked in for 30 years.
And low fives.
Yeah. And if you do it that way, do you have to, you're qualifying at the 5.25% in this example, in case, not the 7%, because that's your real interest rate.
That's your rate. It's never going to go higher. And then, Jim, it behooves us to mention the third option with your seller credit, which is simply to cover your cash position, like your cash requirement.
Yeah, your down payment and closing costs. But we were hoping, what we're planning on doing is Vanessa's going to get some of that money from the down payment program.
Right.
So we are going to double dip. We're going to use the down payment program to help pay for some of her down payment and closing costs. And then we were going to ask the seller to give us a credit so that she could buy down the loan and get the lower interest rate. It's a double whammy. Now, a lot of people are thinking, well, how are you going to get the seller? Mike says this all the time. How do you know the seller is going to do that? So here's some of the ways that we can understand it. If you understand what the going list price to sold price is and understand the ratios we were talking about a little later, 98%, 96%, 102%, you know those numbers backwards, forwards. There are scripts I can use when I'm talking to the listing agent to say, here, we're giving you full asking price, but we're going to ask for this back, but we're going to give you full. And if they tell us no, in some of these examples, Venessa, if she offered full asking price and asked for 3% back, that's still 1% higher than the average sale in the county because it's 96%. And we're only asking for 97% of appraised value, which means they're making 1% more than the county average, right? So if they tell us no because they just want to tell us no and they don't have a good reason for it, my attitude is going to say to them is, so what, you want to wait to get the county average and get less than what we're offering you now? Is that what you're waiting for? And you're not going to do these with houses that just came on the market. Right? House brand new on the market, they might not give you the seller contribution because they have all these rainbows and unicorns dancing in their head that they're going to get this awesome deal and they're going to get 30 people in 3 days, come in and look at the house and have 10 people bid on it. And then they find out that that doesn't happen. Then they start thinking, hey, maybe I should offer something.
I mean, this is where the advantage of working with an agent who is active both on the listing side and on the buy side, like Jim and his team, is like, Jim, you just gave 2 real world examples where sellers were mentally ready to lower their price. One was at 14 days and the other one was at around 30 days, right? So you get a good sense of like days on market triggering mental things in the seller side, like, hey, actually, I will negotiate off of what I really wanted to get. I'm starting to think in my mind, I can take less. So you got to hit them as a buyer. You got to hit them right at those sweet spots. After they just reduce the price, Jim, that's tough to get in and get a concession out of it, because they've already given the concession.
After they reduce the price, right after they do it, if you're asking for a seller contribution, then you're going to get a lot of blowback usually, because they're going to say, I just reduced my price.
Yeah.
So you got to catch these at the right moment. You're right, Mike. And the other thing is you have to have a team. You can't just rely on your real estate agent. If you're just talking to your real estate agent, the real estate agent and you as the buyer are not talking to the mortgage company all the time and having these in-depth conversations about each house, you're going to structure your offer differently. Even though you're the same buyer, if you have good team on your side, they're going to structure each offer to the house you're putting the offer on, not on just your financial circumstances.
I mean,
it's also based on the house that you're turning the offer in on.
It's so logical that the whole idea is to get into a contract that can close, right? So you have to know the parameters under which the buyer is going to get approved for the financing and you can close on the loan. And it's just, I just find a lot out there, Jim, that there's a lot of real estate agents who don't have that type of relationship with a lender where they can just make a call like we did. And you say, hey, Mike, what's the real limit? Like, are we at the limit, or is there some wiggle room? And then if there is wiggle room, like, where do we attack that so that we can put the right pieces together to get into this specific home? And so that's a conversation that your professionals have to be having.
Yeah. At first, Mike was like, I don't think this house is going to work. Then he was like, well, let me go check on this owner income and that owner income. He was like, no, none of that's going to work. Yeah. Then we just kind of said, well, what happens if we do this?
Yeah.
And then all of a sudden we had a light bulb moment and it kind of worked. Now, unfortunately, that house went under contract before we were able to put the offer in, and the agent was very difficult. But we learned a lot from that. Vanessa's going to get a home. And I want to round out with the shout outs just of another couple. So another couple just closed with us recently, Megan and Dylan. Mike was the mortgage broker for that one. Ross was the insurance agent. Megan and Dylan were looking for a single family home. They were way under what they could afford as far as their budget. They knew they were young kids. They're such a cute couple. They're young kids. And they knew what they really wanted to afford as their mortgage payment, even though they could afford more on paper, like the bank would have given them a much bigger loan. So what they decided is they weren't going to be able to get a single family home in Palm Beach County based on their budget. They were probably going to go to a townhome. So they decided they really wanted the single family home because of their dogs. So they decided that they were born and raised in Okeechobee County. So we ended up buying them a house in Okeechobee, Florida, right? And got a really nice house, 3-bedroom, 2-bedroom, 2-bath, gigantic backyard for the dog, fenced in.
Spanking new metal roof, brand new
roof. I mean, they were putting the roof on during our inspection period, brand new metal roof, so they don't have to worry about anything. House was in really good condition. There were a couple of minor electrical things that they needed to fix, which were all done before they closed on the house. And very, very happy and stayed well within their budget. They got a 3-bedroom, 2-bath, single-family home on a nice lot in a decent neighborhood with a brand new roof for under $250,000.
With the payment that they set the limit, right? They qualified for a higher payment, but they knew their budget. They knew where they wanted to be. Very disciplined financially, like really, really great scenario couple, borrowers to be working with, and they stuck to their guns, but they found it. And
the interest rates went up about 1.5 points while we were going through this process from the time we met them until the time we closed. They probably went up 1.5 points because we started talking to them a long time, Mike, before we actually got in the car and started looking.
Yep.
Right. So even with that, we were able to still perform for them. And that's what I want to tell people in this market is that don't let your prejudices or your fears override what the reality is in today's market. What you need to do is sit down with a real consultation and be open-minded and see if what you think you want to happen is doable or not doable. Sometimes the answer is no, it's not doable. And it's better just to hold tight, stay where you're at. And that might be the best option. But don't make that decision without talking to the people as what to do. Here's another thing, Mike. We have a couple, Juan and Saray. I don't know if you remember them.
Sure.
But they did a FHA loan with us, and now they're thinking about selling their house and then buying a new house. And one of the things we're going to find out is I checked on the mortgage information on the property appraiser. Their interest rate was 2.75. You got them, Mike. Okay, I almost fell out of my chair when I looked at it. 2.75. The lowest on record was 2.68 in January 6, 2021. Mike got him 2.75. Right? So it's a good job, Mike.
Yeah, thank you.
One of the spouses doesn't really want to let the mortgage go because it's so damn cheap. And the other one's like, I don't care about the mortgage. I want to move to a different type of house. Right? So we're going through that process right now. One of the things I'm trying to figure out, and this might be our first one, Mike, and I'm going to be very excited about this because I started talking about this in 2018, and now it's going to finally happen. FHA are assumable loans. So Juan and Saray could offer their house with first, we're going to check into this. We got to check with the lender and find out the criteria. But what we could do is offer the mortgage that they have on the house now currently at 2.75% and offer that financing to the buyer at 2.75 and then get a second mortgage for the difference of the new purchase price. Now, Mike.
And remember, you're not starting on that loan. You're assuming the existing loan, Johnny. So you're essentially taking over the payments.
Yeah.
Right. So that loan has 28 years left on it, 27 and a half years, 2.75. Like that's the idea, right? You're assuming the existing loan. There are some, you got it. The existing lender who holds the paper on that loan has to essentially agree to do it and approve it. So that might be the long pole in the tent, but Jim's going to try it out. So I'll be
it's
curious
assumable. If the lenders start telling me no, they're not going to do it, I'm going to file a complaint with FHA. And say, hey, you guys offer an assumable loan, and now the lender won't agree to do the assumable loan. So why are you calling it assumable?
Yeah,
so I'm already ready to have that fight. If we're going to have that fight, I'm going to have it.
Yeah. And then Jim was talking about a second loan. So you're not unless you're really just going to hand somebody over your house, there's a gap between what they want to sell it for and the balance on their loan that they owe, right? So there's some sort of gap there as far as their equity.
So let's just say that they owe $300 and you're selling it for $500.
Right. So you're going to assume the $300,000 loan, but you still owe them $200,000. Right. So where do you get that money? Come out of pocket, pay that gap. That's one thing. Jim's talking about a second loan. So just kind of like a first, second combination. You're not going to get all of the 200, but maybe you get up to 80% LTV, right? Or maybe up to 90% LTV. So you still have to come in with cash, just like you're doing a down payment, like normally, you can't do it with 3.5% or 5% down. So, but I'll be curious how this works out, Jim. So it's certainly attractive, right? If you're a seller and you have that, and you got an FHA loan that you want somebody to, it's going to be an attractive interest rate that can't be touched. Yeah, something to seriously consider.
So just to understand it, what you're doing is that the seller is giving the loan that they have currently at $300,000 to 2.75% and giving it to the new buyer with no obligation on that loan anymore after it's moved over. Because I don't recommend doing it unless the lender releases you from full responsibility, the current owner, right?
Of course.
And then they release that. So now that's all on the new buyer. And then the extra $200,000, they're going to refinance or get a second mortgage on if they don't pay it off. and they're going to do that at the prevailing today's interest rates.
Yeah.
But if you combine the two numbers together, there's huge savings there, which makes your house more valuable than others in the neighborhood that can't offer that. So these are all the creative tools in the toolbox that if your agents aren't talking to you about that, you need to be picking up the phone and giving us a call so that we can give you a real consultation about all your options.
Yeah. And Jim, even going back, like if you're talking about how do you, as a seller, how do you make your home more attractive to attract more buyers? Like even that seller credit thing, where you can automatically just assume 98% of list price. So why don't you just start off that way and say, or maybe after a certain amount of time, hey, we're going to keep the list price the same, but now we're offering an incentive to bring in more buyers. Like we're going to advertise, hey, we're giving you 1%, 2%, 3% seller concession. That's part of our deal, right? Like, come look at this house. There's money for you if you buy this house. So I think that the overall attitude is, excuse me, how do sellers differentiate themselves from the other houses that are for sale in the neighborhood?
You have to show value in today's neighborhood because we have about a third less buyers than we did a year ago, right? So we have about 1/3 less buyers than we did a year ago. So the inventory is increasing, but it isn't increasing as fast as I thought it would. I thought we'd be up to 5 or 6 months inventory right now. The last time I checked, we were at 3.2 or 3.8. I thought we'd be well into the 5 or 6, which is a kind of almost an average market where the seller doesn't have hand and the buyer doesn't have hand, and it's kind of an even Steven market at 6 months. But you have to show value in today's market because the buyers, they're so sticker shocked with the prices and the interest rates. If they're not super excited about the house, they're not putting in an offer. You're not seeing them just throwing in an offer and hoping that they're going to get it and do that. That isn't what they're doing now.
Jim,
And go ahead.
Can I ask you just a general question? Is maybe this is like I'm setting up for you. Is December in general a good time to be a buyer in the real estate market?
Well, usually I get the sellers asking, is it a good time to put my house up on the market during the holidays? So it's kind of a flip question.
Yeah.
The bottom line is when I tell sellers, go ahead and put it on the market during the holidays. Now, Johnny, we put your mom's house on the market in the holidays last year, right around this time, almost a year ago this month, couple weeks earlier.
Yep.
That was probably not a good decision. I'm being honest. I made 2 mistakes with your mom. Number one, when I put it on the market, and number two, I put it way higher than I should have. I really thought we might get it because the market, there was nothing out there. So I felt like the value was there, but because of the type of community it was, it just wasn't happening. With yours, I wish we put it on the market right after January 1st instead of around Thanksgiving. But most of the time when you have buyers coming during the holiday season, they are serious buyers. So they're not
less of
messing
them,
around. And there's
right?
less. Right.
So for me, that means if you're a buyer, like December should be a great time to get out there if you're ready to pull the trigger because there's less competition.
Without a doubt. And also, this is the other thing I wanted to mention is when we were talking about all this, here's one of the big mistakes buyers are making right now. Just plow forward. Don't worry if the interest rate goes up a quarter point or 0.38 1 week, because it might go down 0.39 the next week. It's bouncing all over the place. You just know in general that the interest rates are much higher than they were a year ago. But don't wait around. If you're serious about buying a house, get ready. You might get lucky. You know, people that were looking for houses at 7.08 when it was 7.08 for Freddie Mac, if they find a house this week, they might only be paying 6.49. I'm just throwing out numbers here. Sure. That way, you can't time that. That isn't something you're going to be able to time. It's too choppy and too in the moment. So you just got to plow through. Yeah, you just got to plow through and see where you land and then make your final decision. But waiting, just sitting around waiting, twiddling your fingers, waiting for the market to give you a sign that it's good to do or bad to do, that's not the way to do it in this kind of market. It's better just to plow forward. If you want to buy the house, get ready to buy the house. We start looking. We don't put an offer on it unless you love it. right?
Yeah.
That's the bottom line. You don't put
Yeah.
the offer on unless you love it. But the fact that you're waiting for the interest rates to be right, the prices to, flatten out for you, the interest rates to flatten out, and to find the exact home you're looking for, at the price you want, trying to make that all happen by yourself is very hard. You just got to go through the process and be selective when you turn in your offers for your house.
Yeah, the only things that should be holding you back right now is working on your credit to where Mike says that we're in a position where you can qualify, and saving cash to where Mike says you're in a position where you can qualify. Like if those two things are working against you, all right. Hey, keep on that path. But other than that, let's go.
Yeah, you should. And that doesn't mean you're just going to run out and like go crazy and buy any house that's out there. You have to have a plan. What we do is we don't just show you what's on the market. We also show you over the last 3 months what people have bought that are in your criteria and what they paid for those houses, so that you have an idea in a recent time, not 6 months ago. I usually don't go back more than 90 days. And I actually, for this exercise, I like going back 60 days or less, right? And I'm trying to show people what other people paid for the kind of house that they're looking for, so they kind of understand where it is on the market. And the other thing we're looking for is list price to sold price. And what you're seeing a lot of times, you're not seeing the list price or the sold price being higher than the list price. So if you go into a neighborhood and the neighborhood is a $600,000 neighborhood, but a lot of things are closing 575, 580, 585, right? But they're out in the market for 6. When you see a house on the market for 600, you could automatically start thinking, I'm probably going to pay 570 to 585 for that house.
Yeah, Jim, I mentioned earlier about, like, if you are waiting, you're waiting for something. You have to know what that something is. And so I talk about the boxes that should be checked. Like, I'm waiting for interest rates to be here. I'm waiting for housing prices in this neighborhood to be here. Ultimately, what that comes down to, Jim, is I'm waiting for a specific mortgage payment, right? And if you're waiting for a specific mortgage payment, you have to know what combination of purchase price, down payment, interest rate is going to result in that payment, right? And you're shopping by payment. So how do you do that? It's very hard to do that unless you got a professional helping you do that, right? So number one, do you qualify for that payment that you're targeting? But number two, what conditions need to be right to result in that payment? And that's where you just have to have, like my app has a calculator that can very quickly determine, hey, this combination is going to result in my payment. But if you're looking for that unicorn and you say, well, I can't buy a house more than $350,000 to end up in the payment that I want. Well, guess what? Now you know what to wait for. You're waiting for houses in a specific neighborhood to come down to $350,000, right, at today's rates. So if you're a serious buyer, you have to know what you're looking for and then be ready to pull the trigger when that opportunity
comes. And most buyers aren't going to, like, let's say that the perfect house was Juan and Saray's house, and they can offer the 2.75% at $300,000. I'm making up numbers here, right? But let's say that can happen, and you're not in the market, in the game, if you will, at that point, because you're waiting for, you're waiting to see the headline in the newspapers that this dropped to that or that did this. Yes. And you're not in the market and you're not out there, you wouldn't even know about that opportunity.
Yeah.
If you didn't have Mike's app, if you didn't have Mike's app, and it's not just a regular mortgage calculator you get online where you just plug in the numbers. It's a real app based on your information that Mike plugged into the system. So that's why it sets parameters of whether Venessa can or can't buy that specific home. Yeah. So you have to have that, right? You have to have an agent that's being creative, and you have to have an agent and a mortgage company that's sitting down and going, hey, I know Venessa can't afford this house at this price, but if we got 3% back from the seller, and we did that for buying down the mortgage rate permanently, can she afford the house then?
Sure.
And let me ask. I have a quirky kind of off base question based on this. Mm-hmm. So if you've listened to this show over the years, Mike's always kind of been like, look, down payment assistance, I appreciate it, but if you need it, you're probably not in the best place to buy a home, and it kind of worries him a little bit. Like he'll still, like, hey, I'm an advocate. I'm going to do what I can to get you in that home, but it worries him when you're in need for that. Mike, what's your reaction to the need for such a
Cash.
give from the seller side? Yeah, is it similar to a down payment approach, or is it different for some reason?
I think it's number one, if it's on the table, you take it, right? Like you get
Sure.
as much credit from the seller because you can.
Kind of like when your mom
decide-
offers you money, you don't say no. You say
you don't say no. You're like, no, mom, I don't need that much. Oh
yeah,
okay,
yeah,
fine.
give it to me. Right.
So, so I don't know. I get a little bit worried, like you said, with the cash, but that hasn't always been my primary concern with DPA. My primary concern with down payment assistance is the two strings that are typically attached. Number one is it stays attached to the home, right? So you need to consider that an equity position that you don't have, and most people are not going to be in that home for 30 years, right? Just generally. So you have to think about that. The second one, and this still applies under some of the circumstances, you get an interest rate penalty for getting the help. And so my traditional was like, geez, if you don't really need it or that money can be found somewhere else, I would recommend going away. Now, if that second one is no longer a factor, meaning the interest rates are favorable, like even or even better than the rate would be if you didn't have it, well, geez, that's one pretty big string that has gone away. But if we're in a world where you can get a $10,000 seller concession and you don't need that cash to close, let's say, like, would you take that 10,000 to cover your closing costs, or will you take that 10,000 and kind of put it towards lowering your interest rate or put it towards temporary, mid-range relief on your mortgage payment every month? So, I don't dislike the down payment assistance. I do have that in the back of my head, like, geez, if you're not able to save money right now, do you really want to get into a mortgage payment that's higher than your current rent obligation? Right?
Well, I want to use that question to just kind of emphasize again all the options that are on the table. Jim notes the tool bag, the toolbox, all the tools that they can utilize as a team to get what you're trying to get done right for you and your family. And Mike has these little caveats in his head. It's about you for your future. It's about putting you in a position to where you're not dealing with foreclosure or the stresses of not being able to afford your home after a year in. Those are huge points for people where a year in, you're like, man, I can't afford this home. That stress can kill you. So they're trying to put you in a position to succeed moving forward, not only in this home, but your next home. That the real takeaway is here, the options. And if you've listened to this whole show, the 3-2-1 down payment option from your loan perspective, where the seller's giving you concession, that 3-2-1 scaling of your interest rates, man, that's great to position yourself. Maybe you don't need it, but if you can, you position yourself with you deciding where your money's going. Like, these are valuable conversations. Go to floridatalkrealestate.com. Understand the value of these free consultations. Go to pros, people that are great at what they do. I know you like to think your cousin or your neighbor or your sister-in-law's boyfriend, they got to be great at what they do. Here's the facts. They're probably amazing people. And the odds are high they suck at what they do. Don't go to them just because you're connected to them. Go to people that are great at what they do. I'm here every Saturday to tell you these people are great at what they do. I use them. My family uses them. I will use them in the future. FloridaTalkRealEstate.com. Even if it's just a vetting process and you decide, I'm going to go this route, talk to this team. Find out what they can do for you. And if it's not right for you, go on to the team that you prefer. That's fine. No harm, no foul. It's about making sure you get done what you're trying to get done the best way possible. So many times over the years, this team helps people and doesn't even get their business. Helps them again, still doesn't get their business. Helps them again and still doesn't get their business. Why? Because that's what they do. It's about helping people. FloridaTalkRealEstate.com. Jimmy, you got about 2 minutes. You want to put a bow on it?
I just wanted to throw out the last thing is that I keep reading, and we're going to have these guys come on the show, but I keep reading about these professors at FIU and FAU that are in the real estate school that are still saying that it's better to rent in South Florida than to buy. And I really don't understand the concept of that. So I really want to have them on, not because I want to beat them up, because I want to learn how they look at things. Because, Venessa, for example, she just found out if she doesn't find her new home, she's going to pay 10% more than she paid last year for her lease. And that's actually a pretty good deal because the average is 17% increase per year. You don't have to worry about that when you have a fixed mortgage payment.
I bet you they have some valid points that we don't consider. I'm sure it's about crunching numbers and making wise economic decisions.
If they tell us you could take the extra money and invest it in other ways and get a better return on your money, that's bull.
They probably
because the average person isn't going to do that. That is not a real world.
Like this. You need to get a 3-year lease.
yeah, exactly. Right.
Yeah.
So, but anyway, we're going to try to get those guys to come on the show and explain themselves.
Yeah, yes, explaining to do. Remember FloridaTalkRealEstate.com, your one-stop real estate shop. Know it, use it, love it, share it. You can change lives. Facebook, Florida Talk Real Estate, on YouTube as well. Thank you for being with us every Saturday. And again, remember FloridaTalkRealEstate.com and share it with people in your life. You can really change the world. Mike Rauch, the mortgage guy from the mortgage firm. Have a great weekend.
Thank you, Johnny. Thanks, everybody.
As always, Jimmy D, Keller Williams Innovations, the Florida Home Pros team. That's our fearless leader. Have a great weekend, my friend.
Thank you, Johnny. Have a great weekend yourself. Thanks, Mike.
Jimothy's going to stick around, do the locker room with Greek and Joe. I hope you're planning on staying tuned in. I sure am. See you next Saturday. Florida Talk Real Estate, 2 hours of infotainment right here on Real Radio.